Good evening, everyone. Welcome to your drafting and interpreting financial statements revision session. My name's Louise. I'm one of the distance learning tutors here at First Intuition. Tonight, we're going to be looking at your task 4, which looks at your IFRS 16 and leases. I know leases is not generally a favourite between students. We'll work through this task together and see how you will feel. So, Bagshaw Limited enters into 2 lease agreements for machines. They have a financial year end of the 30th of September. And both machines were purchased on the 1st of January. Machine 1 is a lease, and on the 1st of January, they pay £14,000 so that they can use the machine for 10 months. Machine 2 has a present value of future lease payments of £12,000. The machine has a useful life of 6 years and the lease term is for 4 years. Part A of the task asks us to calculate the amount that will be shown in prepayments in relation to machine 1 at the end of the year and then to explain our answer. So with a task like this, it's probably easier to do the explanation as we're doing the calculations. So we can see that machine 1, they plan to use for 10 months. As it is 10 months, that makes it a short-term lease because it's less than 12 months. Now, I'm going to write the answers in here in shorthand because, as you can see, there's not that much space and these pens are not the nicest to write with. In your exam, you must write in full paragraphs. Hopefully, by this point in your level 4, you know that you need to be writing in full comprehensive paragraphs. So, let's get this angled right, and it's a short-term lease. As less than 12 months. Okay, so if it's a short-term lease, what do we know? We know that it will not be capitalised. It will be expensed. And a prepayment adjustment will be needed. Okay, so let's think about our prepayment. How do we know it's going to be a prepayment needed? Machine 1, it's a lease they took out on the 1st of January for 10 months. Okay, so that's going to take them to October. So they're going to use the machine until October and they've paid for the use of that machine until October. However, the year end is the 30th of September. This means that they've paid for 1 more month in the period that actually relates to the next period. So it's a prepayment. So to calculate the prepayment figure, we would do, let's just use our separate piece of paper. We would do the 14,000, which is how much they paid in total. And times it by 1, divided by 10 to give us the monthly figure of 1,400. So we know it's a prepayment of 1,400 for 1 month. And then that's the figure that we pop in this box here because it asks us how much will be shown in prepayments in relation to machine 1. Okay, that £1,400 is actually for October, which is in the next accounting period. So in this box, we just need to really type how we've came to that calculation. So we've said that a prepayment adjustment will be needed. We now know that that's for October. And as this falls into the next period, handwriting's going very askew, I apologise. And then we'll just put the calculation in there. So our 14,000 times by 1 divided by 10 equals 1,400. And that's the first part of the task. So machine 2, calculate the carrying amount that will be shown in non-current assets in relation to machine 2 at the year end. So let's go back and look at the figures. Machine 2 is a lease. Sorry. Machine 2 has a present value, a future lease payment of £12,000. Okay. And the machine has a useful life of 6 years and the lease term is for 4 years. So the first thing we need to put in down here is the lease is over 12 months. Sorry. Okay, so we know it will be capitalised now. So it's going to be capitalised at £12,000 because that's the present value of the future lease payments. And if it's a non-current asset and it's been capitalised, it will be depreciated. With leases, the depreciation will be over the shorter of the lease term and the useful life. So the shorter of the two, a useful life of 6 years and the lease term is for 4 years. So it's going to be over 4 years. Which is 4 years. Okay. So we're going to do our £12,000 divided by 4 years gives us £3,000 a year. Okay. The year end is the 30th of September, as we were told, and the machine's been purchased in January. So that means it's 9 months depreciation that we need to allocate for the period. So we take our £3,000 times by 9 divided by 12 gives us £2,250 for this accounting period. So the carrying amount is at £12,000 minus 2,250 equals £9,750. That's how much should be showing in our non-current assets in relation to machine 2. Okay. Next part of the task. Slightly different. So Ho Race Limited owns 70% of the ordinary share capital of Blake's Limited. Always super important to get those the right way around. During the year, Blake sold goods to Ho Race. So the subsidiary sold goods to the parent for £45,000. Blake earns a 50% markup on cost for all sales. At the end of the year, Ho Race Limited still had a third of these goods still in inventory. An extract from the statements of financial position for the two companies at the year end show closing inventory as 114,000 for Ho Race and 63,000 for Blake. What is the inventory valuation to be included in the consolidated statements? So we're going to need some scrap paper for this. Just move this out of the way. So the first thing we need to do is find our total value of inventory for both companies. So we have our 114,000 plus 63,000, which gives us 177,000 total. Ooh. Okay. We need to do an adjustment for the unrealized profit, okay? Because there's still goods in inventory. So we know that the sales value equals £45,000. And this is 150%, okay? Because we were told there was a 50% markup on cost. So this must be 150%. Okay. So to work out the profit, we would do 50 divided by, divided by 150 times 45,000. Gives us 15,000 profit. And there's a third of this left in inventory. So we would do our 15,000 divided by 3 equals 5,000. Now, what we do is take our 177,000 that we calculated in the beginning, which is our total profits, take off the adjustment of £5,000 to give us £172,000. And as long as we're correct, there should be a box over here saying £172,000. And the next one. So Bertie Limited purchased 65% of the ordinary share capital of Orange Limited on the 1st of May 2006 for £1,140,000. At that date, the share capital of Orange was 1.2 million 50p shares. So we know that is going to give us £600,000. Can't really see that. I apologise. And retained earnings were £300,000. So that's £600,000 and our £300,000. It is now 2008, so it's been 2 years, and the consolidated financial statements are being prepared. It has been decided that goodwill is to be impaired by 25%. What is the value of goodwill to be included in the financial statement for 2008? Okay, so there's a few things that we need to do here. Some fresh paper. The first thing we need to know is the cost of the investment, which we were told, cost, we were told was our £1,140,000. Okay. Now, next we're going to add NCI at acquisition. Which was our £600,000 plus our £300,000. So that gives us £900,000. Okay. We times that by the 35% that's owned by the non-controlling interest to give us £315,000. So our NCI, our non-controlling interest at acquisition, is £315,000. Now we take away net assets at acquisition. Sorry, my handwriting's awful. Which were our share capital, which is, if you remember, was our 1.2 million shares at 50p per share. So that's 600,000. Oh, I'm going to skew here. So that's our 600,000. And our retained earnings. £300,000. If you add this up, if you do your £1.14 million, add your £315,000 minus your £900,000, this gives you a total of £555,000. And we need to take away the 25% impairment. Oh, apologies. Screen has just decided to disappear on me. Where on earth has that gone? Sorry, excuse me. I have no idea. My Zoom screen has decided to conk out. There we go. Apologies. Let's get rid of that because I can see myself and we don't need to see that. Where have we gone? Okay, back to it. I apologise. 555,000 times 20%, or less 25%, sorry. Equals £416,250. Got there in the end. And that's our answer here. It's just a matter of following the process. So your cost of investment, add your NCI acquisition, which will be your share capital and retained earnings, times by the amount held by the non-controlling interest. Okay. Less the net assets at the date of acquisition. Really important to use the correct dates. As we can see in this question, we're preparing financial statements for 2008, but we still need the figures from acquisition. Okay. So our net assets at the date of acquisition was our 1.2 million shares at 50p per share, which was £600,000, and our retained earnings of £300,000. And the next task. So, which of the following are criteria that must be met for the development expenditure to be capitalised according to IAS 38 intangible assets? So hopefully you have came across the pirate criteria. If you haven't came across the pirate criteria, I suggest you have a look for it, because that will give you the answer to this task. It is really important to learn this criteria. It's highly examinable. It's likely to come up in your exam. So let's have a look. We're using pirate. Let's give us a pen. So let's find our P. Probable future economic benefits will be generated by the asset. That's our P. The next we're looking for is our I, which is our intention to complete and use or sell the asset. Next, we have our R, which is our resources adequate and available to complete, to use or sell the asset. It is important to know these and to be able to explain them. Next, we have our A. This is our ability to use or sell the asset. And our T, which is technical feasibility of completing the asset for use or sale. And lastly, our E, which is expenditure can be measured reliably. So, according to IAS 38, to be able to capitalise development expenditure, we need to be able to meet this criteria. Probable future economic benefits will be generated by the asset. We have the intention to complete and use or sell the asset. We have the resources adequate and available to complete the asset. We have the ability to use or sell the asset. We've got the technical feasibility of completing the asset, and the expenditure can be measured reliably. So we need to be able to complete the asset, complete the production of it. We need to be able to use it or sell it. And by that definition, we need the technical feasibility, we need the resources, we need the intention. And the expenditure can be measured reliably, because to capitalise it, we need to be able to measure the expenditure. Pirate's a really, really, really helpful anagram to use for this task. So I highly recommend that you do learn it. And that's it for task 4. I don't think it's too awful of a task. Thank you all for joining me.